Hello, and welcome to this feature interview brought to you by Livewire Markets. I'm Huntsley, and I am thrilled to say that our guest is Ron Temple, Chief Market Strategist at Lazard. It is incredibly timely for Ron to be here today because our subject is tariffs, or the threat of tariffs, and indeed the US President's actions that could theoretically lead to a second global trade war. What will the impacts be on markets and indeed for investors, not just in the immediate, but also in the long term? Ron, welcome to you. Good to have you out here. Good to see you again.
Great to be here. Thank you.
So, Liz, as we just said, US President Donald Trump has followed through with his campaign promise to threaten tariffs on $1.3 trillion worth of goods from Canada, Mexico, and China. Now, as of taping this interview, and I am going to do something that I've never done in my 3 years here, and that's actually timestamp the taping date. It's Tuesday, February the 4th at 11 a.m. Sydney time. The reason I'm timestamping, of course, is that everything can change minute to minute in these markets. But as of taping this interview, he has paused his threats on Mexico and Canada after actions taken by both those respective countries' leaders, while Beijing and Washington will be having a conversation imminently. By the time this interview goes up, we should know what those changes are, what those conclusions are out of those conversations. But although this situation moves ever so fast, I think we still can put some charts up on screen so that we can start this conversation with some valuable context. Let's take a look at this first one. Mexico, China, and Canada are the three biggest import sources for American consumers. Between those three, 43% of all US imported goods could have been affected. And come to think of it, may still be affected because the moratorium is only 30 days. Everything, for this second chart, everything from fruit and vegetables to wood and crude oil would have been affected by these tariffs. And even though Trump has notionally said that crude oil tariffs against the Canadians will be notionally less at 10%, of course that still affects billions of dollars worth of energy. And finally, while the tariffs on Canada and Mexico would have been new, investors with long memories will remember that tariffs were imposed on the Chinese economy between 2018 and 2020, but the impacts of those tariffs on Chinese imports had a very marginal impact on US inflation back then. Okay, that's my long preamble over. Ron, to you, firstly. Obviously, they're temporarily off the table. They could be back on the table with one tweet. But how much more significant would these tariffs be if they were eventually enacted compared to the ones undertaken in Trump's first term?
Yeah, so for context, basically, if you go back to those tariffs that were imposed on China back in 2018, 2019, they were imposed on a total of $350 billion of exports to the United States. The average tariff ended up being somewhere, let's say, 12, 13%. Importantly, during that period, the Chinese renminbi depreciated by about 8%. So the impact on the U.S. consumer was less magnified than what we might see in this case. Also, a lot of the products that were hit with tariffs were intermediate inputs that corporates would buy. You might recall there was a list 1, 2, 3, 4A, and 4B. List 4B never actually was hit with tariffs. That was largely consumer discretionary items back in the first Trump administration. In this case, instead of $350 billion of goods, we're talking $1.3 trillion of goods. And the tariff Trump had proposed over the weekend was 25%, as you said, on Mexico and Canada, 10% on Canadian oil, 10% on China on top of the tariffs that are already there. Now, that's obviously nearly 4 times the goods that were covered last time. It's a much higher level of a tariff, and it seems less likely that you would see material foreign exchange depreciation or material enough depreciation to offset the tariffs in the case of, say, the Canadian dollar or the Mexican peso. So very important to corporates and consumers in the United States if they happen. Now, importantly, as you mentioned, they've been put on hold for 30 days. What's interesting is the premise for the tariffs was that Trump declared an international economic emergency. This is the International Economic Emergency Powers Act, the IEEPA, that allows the president to say there's an emergency, then immediately apply remedies for the crisis. Now, historically, IEEPA has never been used to raise tariffs. It's been used in cases like Russia invading Ukraine to apply sanctions. So there is a chance, by the way, that this will be contested in court. There could be an injunction where a court says you can't put the tariffs in place even on China, which, by the way, is midnight February 4th, as in the beginning of February 4th, U.S. time. So we're nearing that time if the conversation with Xi Jinping doesn't go well. We'll see if companies sue to stop the tariffs. But bottom line, it's material. And I think, hopefully we can get to this. I think it's a signal that candidate Trump was very serious about using tariffs to solve problems. I think most people assumed the problem he would try to solve was the trade deficit. In this case, he declared an economic emergency because of illegal immigration and fentanyl crossing the border.
I know it's very difficult at this moment to work out what's next, because really it's just based on, whatever he sees. But in your own professional opinion, where do you see the next leg of this story playing out?
Well, to be fair, I was a bit surprised that Canada and Mexico even happened, right? He had talked about it after the election, but sorry to get into technicalities, but typically in the first term, what the president used was Section 301 and Section 232. It's a very legal arcane element. 232 is a section of the law you can invoke when there's a national security risk. 301 is when there are unfair trade practices from a trading counterparty. In either case, when you invoke either one of those provisions, then that kicks off a process where there's an investigation. And the idea of the investigation is to say, okay, first of all, is there really a national security threat? And secondly, if there is, are tariffs the right answer? What should they be? How high should they be? And those investigations usually take months. Now, in Trump 1.0, Section 232 and 301 were used against China and against the European Union and regarding aluminum and steel from other exporters. There were no 232 or 301 investigations of Canada and Mexico. So the reason I brought up IEEPA, that International Emergency or Economic Emergency Powers Act, is because the president had to have a legal justification. So I and others did not expect Canada and Mexico to be in round one. The other reason I did not expect them to be in round one is nearly 5% of all personal consumption expenditure in the US is on goods from Mexico and Canada. So when you slap a 25% tariff on nearly, it's 4.7% of all PCE, in theory, that raises the US inflation rate by over 100 basis points in the first year. So it seemed unlikely that right after winning an election based on campaigning, accusing the opponent of having raised inflation, that one of your first moves would be to raise inflation. So long story short, I was a little surprised by the Canada-Mexico. I do think China, though, this is the first part of the story. Since the announcements over the weekend, President Trump has also said the EU has atrocious trade policies with the US and is on the list for immediate use of tariffs. I think there might have been a strategic messaging intent here to say that even our closest ally can be hit with tariffs. Imagine if you're not an ally. And so I think there might have been a little bit here of sending a signal to every other country in the world, be on alert. And in some ways, maybe what he wanted to accomplish was to have countries come to the United States offering a deal before he even threatens the tariffs. So again, I don't want to overascribe a grand strategy, but I don't think these things happen by accident.
Well, negotiating in chief, perhaps. Relating this back to markets, when the first announcements came out, for those who don't keep track of markets day to day, there was quite a savage move, particularly in currency markets. There was a massive bid into the US dollar, slightly more muted in bond markets. But I think the biggest move, and probably the most notable move, was in equity markets particularly. Were you surprised by such a savage initial market reaction, just given we knew these tariffs? Okay, we didn't know whether these tariffs were coming, but they were proposed, they were headlined everywhere.
I was not surprised by the equity market response. So my view has been since November 5th, since the US election, at a 50,000-foot level, equity markets priced some risk of a trade war. And I say that because you look at the US equity market has outperformed non-US markets by a meaningful degree. If I also look at currencies, the US dollar has strengthened meaningfully, 2-3% depending on the currency you're looking at since the US election. But when you went to individual securities, there was very little evidence of analysts or investors changing their expectations of earnings or valuation for individual companies. And it makes sense, right? Imagine if you're an analyst, or many of the people watching this, you build your model, you forecast the earnings of a company, you discount them back, and you decide what fair value would be in a range of scenarios. Well, if you were an analyst who wanted to put a tariff scenario in, you did not know which countries would be subject to a tariff, how high the tariff would be, what the exemptions would be, how long it might last, what the retaliation would be. What are you
uncertainty.
So what number are you going to put in your DCF, right? So I think investors this weekend finally got some numbers. And by the way, we didn't go into this level of detail, but the policy announcements also said there will be no exemptions. And so you knew that, wait a minute, this time everyone's covered. In Trump 1.0, quite a few companies evaded the tariffs through successful lobbying or, basically advocacy. In this case, we also learned in the executive order that historically there was basically a clawback provision. Let's say you're a big auto company and you imported a part from Asia and then you re-exported the car to Canada. You could claim back the duty you had paid, the tariff you'd paid. In this executive order, it was explicitly prohibited that you could get that tariff refunded. So again, you got a lot more numbers to work on, and that's why I think you saw the market move meaningfully. Although within the first trading day after the official announcement, Mexico already gained a 30-day moratorium. We saw the currencies move materially. And we actually saw oil prices move, in part because of the changes in the dynamics around energy supplies. So not really surprised that we saw that immediate move. I'm a little more surprised by the way that we've already had such a reprieve of that move in terms of the market rallying back during the first trading day in the U.S. I think people, again, a little too optimistic that maybe we dodged the bullet, whereas maybe we just put the gun aside for 30 days.
You talked a little bit just then about Trump enacting these tariffs, maybe purely just to leverage something in return. He seems to have done that successfully with Mexico and Canada, at least for this limited time. Extrapolating, as difficult as it might be, to something a little more long-term, does he think this is genuinely a useful long-term tool which he has to protect the US economy? Or, as you say, what are the long-term implications from something like this, even though we've only had this news for a few hours or so, a few days or so?
Well, I think the most important thing for investors to take away is that this administration views tariffs as a tool that can be used in many different situations. I mean, maybe it's a Swiss Army knife kind of tool that you can pull out at, whether it's illegal immigration, drug trafficking. I think tariffs might be used for countries in NATO who don't spend 2% of GDP. It could also be used for countries with very large bilateral trade surpluses against the US. And so I would look at this as these tariffs will be deployed more frequently in a wider range of scenarios than would historically have ever been contemplated by most presidents. So that's one takeaway. I do think, by the way, the one that was most confusing, by the way, was Canada. Because with fentanyl, just to give you a sense of the numbers, in the last year, 9,600 kilograms of fentanyl have been seized at the border with Mexico. In the same period, 19 kilograms were seized with the border of Canada. So there's a completely different quantum on the drug side, and there's a completely different quantum on immigration. So it was a bit surprising. Again, Canada was the oddball. I do think, though, as we extrapolate out, you will see tariffs used more frequently. I think many of them will stick. And I do think there's also a case to be made that you might start with a 25% tariff being the threat and you end up at a 10% tariff. That's still a 10% tariff that was not there before. That does change corporate profit margins, does change growth, and does change inflation.
Does the revoking of these tariffs, even if they are temporary, do you think it puts less pressure on the Federal Reserve and its current rate easing campaign, or do you think it doesn't really affect them?
Well, let's be clear. Even if just the 10% tariff on China stays in place, that does increase prices in the U.S. U.S. core inflation using this consumer price index, core CPI, for the last 7 months has been 3.2 or 3.3% every month on a year-on-year basis. And although I do expect some further disinflation or decrease in inflation rates in the next, say, 6 months, I could easily imagine a scenario without tariffs where U.S. core CPI stabilizes at 3. Typically, U.S. core personal consumption expenditure, PCE inflation, runs about 40 to 50 basis points below core CPI, so that would imply a 2.5% core PCE. If we end up stabilizing there without tariffs, and then you add tariffs on top, you add the inflationary effect of stricter enforcement of immigration regulations, you could see that PCE topping 3% again, core CPI topping 3.5%. This is not a scenario where I think people should be expecting Fed rate cuts. And so markets prior to these tariff announcements were pricing 2 rate cuts by the end of 2025 from the Fed. After the announcement, that went to 40 basis points from 50 basis points by year end. I think there's a good chance we get 0 basis points by year end because I think the Fed is going to see this as evidence that the risk is to the upside on inflation, and they want to keep some dry powder in terms of not having to reverse policy at some point later in the year.
That brings up a follow-up question which I'd like to ask you. If investors should not be surprised that there are no more rate cuts this year because of these tariffs, what chance is there, A, of a rate hike, and B, tariffs creating potentially a stagflationary scenario? And I bring that based on a conversation I had with Bob Michael at JP Morgan Asset Management, who I offered the same question, and he said, well, every model has to factor in the possibility that tariffs could lead to a stagflationary environment or a stagflationary type outcome. What do you say to that?
I do think the monetary policy outlook is somewhat asymmetric. In 2025, I mean, even Jay Powell said this last week, the most recent FOMC press conference, the probability of a rate hike, I think, is very low. You can never say never, but really low. Let's put a single-digit probability in 2025 of a rate hike, in my view. But to your question about a stagflationary environment, I want to be careful. The word stagflation, I think in many people's mind, conjures images of the 1970s and early 80s.
The oil embargoes.
And basically, double-digit inflation with low growth. To me, when I think stagflationary, I think 3 to 4% inflation with real GDP growth of 1% seems pretty stagflationary. And so I do think there is a chance that a trade war, if it became a full throttle trade war combined with the immigration rule changes, could lead to a meaningful deceleration of growth. If you look, by the way, at a range of economist estimates after the tariff announcements this weekend, most of them were coming down to US GDP would slow 50 to 100 basis points if you had the tariff of 10% on China, the 25 on Mexico, and the 25/10 on Canada. If you broaden that out, include Europe, broaden that out to other trading counterparties, it's pretty easy to get to over 100 basis points reduction in GDP. The Peterson Institute for International Economics, by the way, which I think does great nonpartisan work, has estimated US immigration policy changes could be as inflationary as trade policy. You could easily get inflation of 100 to 150 basis points higher, GDP 100 to 150 basis points lower. That gets you to what I just described as 3 to 4% inflation with a 1% real GDP growth. And by the way, all of that does tie back indirectly to corporate profit margins, which has real implications for the equity market when you're trading at 22 to 23 times forward expectations.
And credit markets, where spreads have been tightening for a long time now. Okay, so that's the global picture. Let's bring this back to Australia, because we are in Sydney and we have a primarily Australian audience here at Livewire. While Australia is not being hit with tariffs at the moment, obviously it doesn't mean that Australian investors won't be affected. So where, in your view, might Australian investors be affected most by the impact of these tariffs, should they eventually come to pass?
Well, I guess the first thing I think of is, could at some point Australia be the target of tariffs? Possibly, but seems unlikely to be high on the radar. If you look at the countries that have been targeted first, they're 3 of the top 5 bilateral trade surpluses from their perspective, trade deficits from the US perspective. So there is a prioritization targeting mechanism around size of trade balance or imbalance. There's also clearly no illegal immigration from Australia into the US. You'd have to swim a long way. So effectively that's not a risk. Drug trafficking is not a risk. Spending on the military seems like less of a risk. So again, seems less likely. But the second way I would think about it is, what are the effects on the biggest customers of Australian exports? What are the biggest kind of indirect effects? Clearly, China has been in the doldrums for 4.5 years, given the real estate crisis. I think most people have written off the idea that you get a major infrastructure package or program there. But I guess if there's a net positive for Australia, all of this geopolitical tension, the trade tariff tension between the US and China, in my view, is going to lead to a massive move of foreign direct investment away from China in the next decade to other emerging markets. Because I do not believe big US and European companies are going to suddenly bring all their manufacturing back onshore, because labor is still too expensive in most of the developed world. They're going to find another, perhaps a bit more expensive emerging market other than China, and they're going to move, whether it be India, Indonesia, Thailand, Vietnam, Mexico, we can go down a list. And I think if you think about the infrastructure investment those countries might have to make, could be a net positive for commodity exports from Australia. There could be other positives there. So maybe that's one other lens to look at it. And then I guess the last one is broader kind of currency movements and interest rate movements. To the extent US inflation does end up running higher and interest rates in the US stay higher for longer, I do think you could actually see widening divergences in central bank policies. We can debate where the RBA would sit in all of this, but I do think you'll see more dollar strengthening probably against the euro and certain other currencies. Could there be impacts of that in terms of producing commodities in Australia that are sold in USD, but your cost base is in AUD? We could think through those impacts. So again, a lot of indirect impacts.
And a lot of question marks.
A lot of question marks. There's a lot of uncertainty, and I think if there's one thing we can predict about the next 4 years is it will be quite unpredictable.
Yeah, well, absolutely. You talked to crude oil earlier. You just mentioned the US dollar again. One asset which we haven't mentioned in all this is gold. Obviously, all of these assets are intrinsically linked to geopolitical risk. You and I have sat together a few times in this format, and we have talked extensively together about geopolitical risk. How much has the geopolitical risk premium just increased with these tariff threats? And I guess for the end investor, is now the time to be buying more of these key hedges like US dollar, like gold, given the uncertainty?
I do believe you'll see continued strengthening of the US dollar in 2025.
Okay.
I think there's more runway there. I'm pausing though, because I do think we will potentially see peak US dollar strength this year.
Yeah.
So the way I'm trying to think about the US dollar is how strong does it need to get, and conversely, how weak do other currencies need to get? How big of a divergence in equity market valuation do I need to see to really just make it irresistible to move capital out of the US into non-US markets? And I think we're going to get there. I mean, I've been waiting for these tariff announcements because I think I basically have been very clear. I thought it would be a kind of buy the rumor, sell the news type story. The market hasn't basically, reacted to the tariff threat in certain economies and companies. Maybe when you finally have the reality of the tariffs, you get that sell-off in emerging market equities, or you get a sell-off in certain European equities, you get the currency sell-off, and that's when you want to move capital. So I'm trying to think of it in those ways. So yes, there's more runway in the dollar, but I would be thinking when you exit that trade as opposed to piling necessarily onto the trade right now, depending on longevity of your time horizons. On gold, this is the cringeworthy question for me because gold has no cash flow. I can't discount back the cash flow. But at least gold has thousands of years of history of being a store of value that's relatively stable. In that next week you have a pretty good idea of what range of prices you're likely to face for the commodity. And we have seen, by the way, an amazing, pretty substantial move in gold prices in the last 12, 18 months, part of which driven by central banks accumulating gold and a range of other factors like geopolitics. So could I imagine gold prices being higher? I mean, put differently, is the probability of higher gold prices higher than the probability of lower gold prices in the next 12 months? I think the answer is yes. It's more likely that gold is higher than lower. But it's still not my favorite geopolitical hedge because I can't give you an empirical
Well, what is
basis.
your favorite geopolitical hedge then?
Oh, geez, why did you have to follow up with that? No, I think, geopolitical hedges, they're tough. I do think there's certain areas where you can look and say there are certain themes in the market that will persist regardless of geopolitics.
Sure.
Not regardless of geopolitics, because of the geopolitics. Number one is defense spending is going to go up globally.
Yes.
I mean, you're going to see a lot more defense spending out of Europe. We've had countries like Estonia, Lithuania, Poland now endorse a 5% of GDP defense target. No one in Europe is there. Poland's at 4.7%. It's a little easy to promise 5 when you're already that close. But you're going to see a lot more spending out of Europe. I think you're going to see more spending in the US. And as geopolitical tensions rise, that theme accelerates. I do think income-producing real assets are a good geopolitical hedge. And maybe less geopolitical, but just a better hedge in general, because a lot of the outgrowth of the geopolitical tension is higher inflation pressure. And having something that produces income that is a real asset with a replacement cost could be a good place to be. And I think the other place that maybe people don't think of as much is finding companies in the equity market that have pricing power. And there are empirical ways to identify these companies looking back through time, although let's be honest, they're not extensive statistical samples of high inflation periods in most countries. But you can do it empirically. You can also do it qualitatively, where you find companies with amazing brands where they're able to raise prices when there's more inflation, or they're the low-cost producer. So when there's more inflation, people gravitate toward their product and they have more pricing power, where they have network benefits, competitive advantages they're enduring, ... I've basically just described high-quality companies. The key question there is, I'm sure you've heard from my colleagues here in Australia, is paying the right price. So it's absolutely critical to identify those quality, let's say, pricing power stories, but knowing what you got to pay for them, because if you overpay, you're still going to lose money. And I think that's probably the best place to be, because when the geopolitics, when those kind of tensions fade, you still own a great company with a high quality kind of competitive moat to protect its advantages.
Yeah, and you think that's probably the one tangible move that investors can make at the moment? You know, if you want to insure your portfolio, right? If you don't want to be caught out again by these moves, is that the one tangible move you could say to investors to do right now with their portfolio?
I mean, I think there are a range of moves. So whether it be the income producing real assets, the quality stocks, the defense theme, I think those are things that should be top of the list. And I guess maybe the flip side of this is really carefully examining everything else you own to identify vulnerabilities and risk. I mean, if you own a lot of very highly valued stocks and rates end up being higher for longer, at least in the US context, we're getting pretty close to a tipping point. The US 10-year Treasury around 5% starts to become more meaningful. And the reason I say that, by the way, is when we got to 5% in October of 2023, BAA corporate bonds, just using the Moody's BAA corporate bond index, were yielding about 650 to 675. At that point, if you're a major...
For the benefit of the audience, that's high yield or investment grade?
It's the lowest rung of investment grade. So you're still investment grade, but right at the bottom.
Yeah.
And the reason I highlight that is, imagine you're running one of the biggest public pension plans in the United States, say a big state pension plan. Most of them have a return assumption of around 7% a year. Well, if you can own a low-rated investment-grade corporate bond and get 675, why take the risk of equities? You start reallocating out of public equities. And so with the 10-year Treasury yield hovering around 450, we recently were at 475, you're getting closer to those levels where I think it does start to chip away at the attractiveness of U.S. equities. And so I would encourage people, look within your equity portfolio, how much of it is in very highly valued stocks where the growth expectations might be difficult to realize, where higher discount rates could really create some risk, and focus on that. And that also should take you into the more global universe and saying, is now the time, or is the next 3-6 months the time to be maybe taking some money out of expensive US equities, moving them into other markets? Personally, I think Japan is a very interesting market. I've thought that for a while. I think there's a really idiosyncratic story there. I think EM ex-China could be a very exciting story for the next decade as capital leaves China, as people de-risk their China exposure. And by the way, I think as you look around the world, you can find plenty of single stock opportunities to take advantage of.
Ron, this has been a fantastic conversation filled with brilliant insights. Thank you very much for joining us at Livewire. We really appreciate it.
I agree. Thank you so much for having me.
And thank you for joining us. If you enjoyed that interview, and why wouldn't you have? You can subscribe to the Livewire Markets website as well as our YouTube channel, where there is great content to be found all the time. Until we see you next, thank you for reading, for watching, and for listening. Take care.